Hello, everyone. Good morning, good afternoon, and good evening for those of you dialing from Australia and beyond. It's my pleasure to moderate this panel on tackling climate risk, and I'm honored to have as a fellow panelist some esteemed speakers, subject matter experts on the field, representing three major regulators across the world. So I'm joining this talk from Mr. Kenneth Gay, from Chief FinTech Officer and Executive Director, Enterprise Knowledge Department of Monetary Authority of Singapore. Hi, Kenneth.
Everyone.
Then we have Dr. Sean Carmody, Executive Director, Policy and Advice Division from Australian Prudential Regulation Authority. Hi, Sean. Thank you for joining so late from Sydney. And Mr. Marc Reinke as Head of Sustainable Finance from the Netherlands Bank.
Hello.
So thank you very much. Thank you. Very quick, 2 sentences just to set the scene. Obviously, climate risk, we talk about it, and it's not a distant risk. It's already happening now. We see that the losses related to extreme weather events are increasing year-on-year basis, and that is impacting directly homeowners, small businesses, medium business, as well as the economy, society, and at the end, the financial system. So regulators have the difficult task to make sure that these risks, which are concentrated in the financial sector, are not posing a major challenge and destabilizing this platform where the allocation of resources takes place. We need to move to adaptation. We need to move to resilience. So how do we do that? Obviously, adaptation finance has to happen. And on top of that, we need to start pricing climate risk to make that channel and mechanism effective into the market. So we need stability and we need valuation pricing. These are bigger challenges which regulators, of course, have to deal with. And I believe that there is a lot of learning. It's the first time we don't have a historical precedent dealing with climate to that extent. So it is challenging for the regulators, it's challenging for financial sector. So I believe everyone is trying to do the best and make it as smooth as possible. To go deeper into the challenges, the expert will discuss that. I'll just moderate when possible. We'll have Q&A at the end, so I do encourage the audience to post Q&A in the chat, and we'll take these questions so to make it more interactive, but also more meaningful, more relevant for the audience. And without further ado, let's kickstart this discussion. Kenneth, may I start with you? One question which I have is talking about climate risk, talking about which core task at your institution take already and have integrated climate risk into account at MAS?
Yes, thanks for that question, Entela. Yes, so at the MAS, we are exploring the incorporation of climate components in a few functions, which I'll go through. So first, in terms of macroeconomic models, we are exploring this, incorporation of climate components. However, this is not a straightforward task. As we all know, climate events cannot be easily modeled using traditional linear models, and hence these traditional models tend not to adequately project climate effects. At the same time, climate tipping points, when they are crossed, can suddenly push the system into a new and irreversible state, and such discontinuities are difficult for traditional models to handle. So we are aware that in the literature, the focus has been on integrated assessment models, which combine climate dynamics with economic, societal, and energy models. However, these models are highly sensitive to assumptions which may be based on little or no existing data. So MES, MES, we are keeping close tabs on the developments in this space. So besides the economic analysis, we are also conducting stress tests for financial stability surveillance purposes. And these stress testing scenarios account for physical climate events so that we can better understand the financial risks associated with physical hazards. So for example, in our 2022 industry-wide stress tests, MES had explored the impact of an acute physical risk shock, specifically for ASEAN 5 economies experiencing a 1 in 200-year flooding event. Our stress testing results showed that floods can give rise to material losses, firstly for banks, due to projected flood-related credit losses, and second to insurers due to the increase in property-related claims. Finally, MES has also published guidelines on environmental risk management for all our banks as well as finance companies. So these guidelines aim to enhance the banking industry's resilience to environmental risks by encouraging improved awareness and heightened attention, and also focusing attention on risk management. So this allows the standardization also of financial supervisors' approach to assess each financial institution's resilience to environmental risks and their exposure at both customer and portfolio levels. Yeah, thank you.
Thank you, Kenneth. It's a very comprehensive question, and it's a very comprehensive answer. Thank you for that. Maybe Sean or Marc, would you have anything to add or something different that your organizations are doing?
Look, I might sort of jump in. I mean, very similar to Kenneth, we at APRA have been making use of scenario analysis. It's obviously a very kind of useful tool that that regulators like to use. But I think one of the things that's a bit different when it comes to climate risk is that traditionally when regulators or supervisors look at scenario analysis, they tend to look over sort of relatively short time horizons, 3 to 5 years, that sort of thing. Whereas obviously we know that some of the most significant impacts, although, as you say, we're seeing some of the impacts today, but those impacts are only going to grow over a sort of longer time period. So we've been making use of the some of the scenarios that have been published by the Network for Greening the Financial System. I'm sure that many on the call will be familiar with some of those scenarios, which have really become quite a benchmark amongst financial regulators around the world, and many of us do make use of those scenarios, and that's something that we've done. But we use them all the way out to 2050. So that's one aspect that's different from a traditional stress test. Or the other thing that's different, and sort of happy to go on to this in a bit more detail later on, is that particularly when you're looking at the physical risks associated with climate change, it becomes actually quite important to be doing that modelling quite a sort of localized, granular level. So that's something that we've experienced. I'm happy to talk about that a bit more later on.
Yes, we might come to that. We want to dive a bit deeper on that subject. Marc, anything to add to that?
Well, the disadvantage of going last after two of such esteemed speakers is that I don't have that much to add. Also, obviously representing a central bank like Kenneth, I think the extent of how we approach this topic is very similar. We really try to incorporate we really try to incorporate climate risk management into the breadth of our core tasks. So both on our central banking side as well as on our supervisory side. So things that I've heard here before from the other speakers. We are also doing climate stress testing, scenario analysis to really understand the systemic element of this all. We're also really analyzing sort of the pricing of climate risks in financial markets and trying to understand that well. We do quite a bit of economic research and advice that we then bring to our elected policymakers, both here in the Netherlands as well as in Europe. It's really more of the sort of the long-term insights around physical climate risk-related policies and the economic and financial consequences. And on the supervision side, we do very similar work, I think, as to what Kenneth laid out. We're also really trying to incorporate climate-related risks into our core modeling of the more like traditional risks. We in the end believe that climate risk is a driver of traditional risks like operational risks or liquidity risks or strategic risks. So we really feel that integration of climate into our core tasks means that we also really understand how it influences those more traditional risk categories. So we're
absolutely.
Do you still hear me?
Yeah, it was a bit choppy, but I think.
Oh, sorry, my screen. Yeah, my screen. I was rounding up. Maybe one last part to mention is that that we also in sort of our own operations as a central bank, we try to really incorporate climate risk. And I want to mention there's maybe our own investment portfolio that is relatively sizable for a central bank as well, where we really try to become Paris aligned and also really incorporate, the more physical climate and nature risks, I might say, into the way that we pursue our own operations. I'll leave it there.
Oh wow, that's a full coverage. I mean, it's almost a 360 degrees of integrating climate in various aspects of the bank. From the investment side to the stress testing to the research piece to supervision. So it's really great. But we're talking about physical climate risk. Obviously, is the challenge is, I believe there are many challenges, and I'll let maybe Sean it will be great if you can touch into that. It is not an easy task because we are bringing climate science into the financial market, and we are financial people. We are not climate scientists. So understanding, making a mapping a hazard in the dollar value. There are different ways. There are robust ways, and there are high level approach to it, but of course that the quality of the output is not the same. So how do you balance all this, and what are the challenges of bringing physical risk into account? How do you deal with these challenges?
Okay, challenge is certainly the right word. I mean, we to share a bit of our experience. We're actually midway through our second major scenario analysis exercise. The first one we completed a couple of years ago, which focused on the 5 largest banks in Australia. We're now doing an exercise that focuses on the 5 largest insurers. But one of the things that we learned through the exercise with the banks was, although that already went down to a reasonable level of granularity, we did supplement the NGFS scenarios, doing what's often referred to as downscaling, where we sort of took the broad parameters of the NGFS scenarios and then tried to sort of break that down to a sort of more localized level. But one of the insights that we took from some of that analysis is that averaging really hides a lot of the risks in the world of physical risk. It sort of always reminds me of a bad old joke that people sometimes talk about, the man who had his head in the freezer and his feet in the oven, and on average his temperature was just right. And that very often averaging can really hide the effects. And some of the things that we see in Australia, and it's true of a lot of worlds, is if you take just one of the physical risks that this scenario analysis look at, and Kenneth touched on this one as well, and one of the significant ones is flood.
Yes.
But when you look at the impact of floods, what you can see is even if you go down to the level of a single street, you can have houses at one end of the street that are highly exposed to flood risk, and at the other end of the street that are much less exposed, simply because of the differences in elevation along the street and where the flood levels will rise to. And so if you just take a sort of quite a broad average that looks at a whole region of a town, you'll lose the fact that there might be some areas that are relatively unaffected and some that are really quite acutely affected. So that presents a real challenge, because how do you do that work at the right level of granularity so that you don't average out and hide some of those more severe effects? And as you say, that's not necessarily a skill set that financial regulators and supervisors are used to having. So what we've done through both of the exercises, including in the exercise that we're working on at the moment with the insurers, is that we've worked in close collaboration with some third parties. We've worked closely with the Bureau of Meteorology here in Australia and sort of climate authorities. And we also, for example, when we look at the physical risks in this insurance scenario, one of the important ones in Australia is tropical cyclones. We have in Australia a cyclone reinsurance pool authority, and we've been working closely with them as well. So we draw in sort of external expertise, sort of modelling expertise to help supplement the work we do. And in fact, for the exercise that we're doing right now with the insurers, which it's a bit less traditional. The work we did with the banks was very much a traditional Prudential perspective on what's the balance sheet implications of these different scenarios for the banks. What we're doing with the insurers, partly because insurers have the ability to reprice risk fairly quickly. They typically tend to offer products with a 1-year horizon. they can, if risks start to increase, they can increase premium or withdraw offer. And so they can actually quite effectively protect themselves from some of the financial risk over a 12-month horizon. However, what that means is that some parts of the country might end up being underinsured, an emerging protection gap, which then can create financial risks for banks, because banks will be typically expecting or requiring insurance coverage that may not then be available into the future. So the focus of our exercise is on insurance availability and affordability. So we're really asking the insurers to model what would the affordability of insurance policies look 10, 20, 30 years down the track. And we're actually asking them to do that modeling down to the individual address level, at the individual property level. Now, that'll then be aggregated in some form to provide us some of the insights, but we're doing the modeling at that level of granularity, which does mean that, again, another challenge, which is a bit new to us, is the sheer volume of data that we're going to have to manage through this exercise is something that's on a scale larger than we've had to deal with before. And so that also presents some unique challenges as well.
Yeah, absolutely. I mean, being in that field, I know it's a huge task. It's always like really managing high quality, high granular data to which come with a lot of the very high cost and a lot of expertise for the output. But to that end, I think the insurance plays a role in, like, we need to stress test in a mortgage portfolio. From the bank perspective is, of course, you have to have insurance on that. For a flood insurance, if your collateral is exposed to flood, then you have to come up with insurance, right? So that brings back the interconnectivity between insurance industry and the banking sector, and who has to bear the risk, and how much the banks will have to adjust for climate because of lack of insurance, or there is insurance, or you make insurance compulsory, like it's happening already now in Europe. So how do we deal with this? Kenneth, there is a question. I think maybe would you be able to shed some light on that, on the Q&A chat, asking about stress tests and potential interconnectedness within the financial industry?
Sure. Maybe I'll make some initial remarks and then hand over to Kenneth, because I think sure. I'll just pick up the sort of one point that you said, referenced there, which is that interconnectivity between banking insurance through the insurance of the collateral that support loans is very important. And one of the things that we really want to understand is what are the implications of the impact on insurance through to banks, because while it is standard in Australia that when banks provide a mortgage, for example, to purchase housing, that it is a requirement of that lending contract that insurance is in place. However, these are 25, 30-year mortgages. And if a borrower does have insurance in place when they first draw down the loan, but then the price of that insurance goes up and maybe 5 or 10 years later, they can no longer afford that insurance, the loan's already out there. And I think in practical terms, it's very unlikely that a bank, 5 years after offering a loan, will say, well, since you can't afford your insurance, we need you to repay the entire loan now. So as a matter of practice, regardless of what the contractual expectations might have been, that ends up being a risk to the balance sheet of the banks. And it's something that the banks are increasingly thinking about. In fact, when we did the exercise for the banks a couple of years ago, they actually asked us, well, what should we assume about insurance coverage into the future? At the time we said, that's a very good question. We don't have a great answer. And so between us, we came up with some high level assumptions, but that's one of the things that we're really intending to use this insurance exercise to do, is to feed back and provide a useful reference point for future scenario analysis for banks. But Kenneth, I might hand to you to sort of talk about interconnectedness more broadly than that specific aspect.
Thanks so much, Sean. I mean, I don't really have that much to add on the, your very rich answer already, but suffice to say, at least for insurance.
Thank you, Sean.
Yeah.
Can you have a answer to the question? Which
one? Sorry, hi. Can you guys hear me? Yeah, you can, right? Yeah. I was going to say on insurance, actually, in addition to what Sean had shared, that we also need to take into account the so-called spillover effects, right, between insurers, reinsurers, as well as the market for risk management instruments such as catastrophe bonds. I think this is important in building up the overall picture of risk mitigation, right? The ability of the mitigation capacity of each jurisdiction after a climate event takes place. Yeah, so that's pretty much what I have to add to the very detailed answer already. Thanks so much.
Absolutely, very good answer. Yeah, absolutely. It's all about risk transfer. Where do this risk go? Who is holding the risk at the end of the day? Marc, may I come to you on the, on this challenge, right? So obviously it is not easy. Do you collaborate with other regulators? Do you share best practices? And I mean, how does that collaboration looks like?
Yeah, absolutely. Yeah, good question. So I think that collaboration on this topic is essential. With stating the obvious, obviously, climate change, nature degradation, these are global problems that we won't be able to solve by only applying some local approaches. And I think the power here is to really collaborate to sort of ensure that we can maintain somewhat of a level playing field, but also that we really share the best practices that are around, that we really learn from one another, that we pick up on what goes well somewhere, what has been tried, etc. So in general, I see a lot of collaboration on this topic, and I see it increasing. Sean, I think, already mentioned the NGFS, and that is obviously for central banks and supervisors working on sustainability, the primary network that they leverage for indeed sharing best practices and sort of working on topics that we think are of importance. So Sean is and he can speak to it more himself, obviously, but he leads a task force on adaptation. I lead a task force on nature-related risks at the NGFS. So these are things that where we can really push the knowledge a little bit, also because we're not a standard setter. It's really a coalition of the willing, to an extent, where we can create new knowledge and really explore topics. And might I also say that the MAS of Ken is a very active contributor at the NGFS. But it also happens. It also happens broader around the world, right? So think of the Basel Committee for Banking Supervision, the Financial Stability Board, the European Central Bank, the Single Supervisory Mechanism. These are all, global or sort of regional cooperation mechanisms where the topic of sustainability is more and more on the agenda as one of strategic importance. And I think also that, the governance setup that is chosen is increasingly fit for purpose. I maybe wanted to pick out one particular concrete example, because that might also be nice to speak to and learn a little bit more of cooperation that I'm particularly proud of, speaking from the Dutch Central Bank, which is a so-called digital twin project. So it's part of the Bank for International Settlements Innovation Network's working group on green finance, a whole mouthful, but basically a sustainability working group. We have worked on this together with colleagues from France, as well as the Hong Kong Monetary Authority, which is a project that uses this digital twin technology to model and enable insights of physical climate-related risks on the latest available information, really ranging from data input all the way to visualization. And it sort of facilitates the understanding of physical climate risks in decision making by central banks and supervisors when natural catastrophes occur, or when changing circumstances affect forward-looking estimates of these risks. And I think the development really benefited from an open source approach, which really facilitated that collaboration on a very, concrete, granular level between the different institutions. And it also really resulted in some tangible technology. And because it was open source, we really fostered, as you can say, almost like a community-driven ecosystem where we shared best practices, standards, protocols, and also let them evolve. Basically, and starting from a sort of a theoretical framework and open source IT solution, it could be applied to 3 different case studies that were also quite different in a lot of ways. But the essence, I think, was that with 80 to 90% of the code that was generic and has been used in all 3 projects. So that's really that's really an example, I think, of where we were able to cooperate, really put something down concretely that others can also tap into, and where also the sort of the public community or the semi-public community of central banks and supervisors can really deliver something of a public good here that might help. So, you know, in short, I really think that collaboration is needed, both on that sort of high, generic, almost diplomatic level, where we agree on parameters of the transition and principles, and we're concerned about level playing field considerations, and really set out the strategic guidelines for how this transition can be done, but also really at the granular micro level, where we work on solutions together and also make them available to the wider finance community.
Which is very relevant, absolutely. And that, I think I can lead the question to Kenneth. The regulators come up with their frameworks, but one bank which might have certain, might be located in Singapore, Hong Kong, and Netherlands, they'll have to comply with different regulations. And we see that in when we talk to the banks, it's like different regulators are asking for more or less the same thing, but different hazard and different standards, and so it's a bit challenging. So to what extent is there an effort that from the regulators to tailor the regulation to the local financial sector, but not maybe tailor too much, because then is these banks will have to use completely different approach in different countries, right? So to what extent you go local but not so local?
Yeah, thanks so much, Entela. So what I would say is this issue of regulations is of course quite challenging, right? Because as we had discussed earlier, even the data issues, or rather the climate risk issues are already challenging to measure to begin with. So I actually wanted to build just briefly on the point that Marc had already raised on the digital twin project that the DNB and other central banks had collaborated on. Actually, we are very fortunate that our colleagues from the DNB and other central banks as well have not only built this digital twin product, but also contributed it to a broader effort by the BIS Innovation Hub to actually share, right, this not only the analysis itself, but the codes that underpin this analysis with other central banks and regulators. So we actually call this initiative the Ellipse Data and Knowledge Platform Collaboration Community, or the EDKP community for short. So this initiative, actually, through this initiative, it doesn't actually directly address this regulation question that you had answered, but what it does, accomplish in the first instance is to have at least a more common sharing and understanding of the analytical parameters, right? In this case, for digital twin, which can then serve, as a means to then further this discussion on, like what you say, striking a better balance between the global and the local in terms of rules that may apply arising from the output of the analysis that goes in. Thanks.
I'm happy to jump in and add a bit on that.
It's very good. It's really fun. Please, John. Yes.
Look, the one thing I was going to add is, and Marc sort of touched on earlier, the sort of role of standard setting bodies, such as the Basel Committee and so on. And I think one thing that sort of comes to mind for me is that people will be aware and I was having a conversation recently with someone from the IFRS Foundation that sits above the ISSB and the IASB, and one of the things she said is that a word that people like to talk about a lot in the context of climate at the moment, when they talk about disclosure and taxonomies and a whole range of things, is interoperability. And her challenge was, well, one thing that's even better than interoperability is the same. So to the extent that different jurisdictions, where they can actually have the same requirements, that actually provides a lot of value in particularly sort of larger organizations that operate across different jurisdictions. It can be quite useful in sort of minimizing the cost of reworking. Now, that won't always be possible in every aspect, you know, for things like sustainable finance taxonomies, where you're talking about what constitutes you know, a sustainable project. It can be dependent on the specific industries, geographies, and so on of that region. But I think the more as sort of regulators that we can, you know, really work together and sort of share these sort of better frameworks and actually use the same as much as we can and only deviate where it's really necessary, I think that really does help a lot in this domain.
Yeah, and absolutely, there needs some level of standardization, collaboration to make it easier for financial institutions, banks, and insurance to understand the climate risk and integrate. But at the same time, so we need to push them for more in-depth analysis of the climate risk, because sometimes, of course, it's material. Like flood is not everywhere, and some countries will be exposed more to other, like a drought or extreme heat. So from the country and sector perspective, certain hazards are more relevant than other hazards, but we need to cover at least the major ones, the one which drive the dollar losses in the system. So that needs to be compliant and focus or compulsory across market, I believe. One more question, and then we go to there are some questions on the chat. But Sean, if I can go back to you, we're talking about, you know, as you know, the climate change has been a global challenge, and adaptation, again, going to the localization, needs to be local. How do we achieve that? And also, I would like on this question, if you can shed some light on the latest piece, latest conceptual note on adaptation released from NGFS, which you co-authored. I read it first, and I need to read it more in depth. You talk a lot about adaptation and the need for effective adaptation, which is very important. It has to be meaningful and localized. So otherwise we cannot adapt. We cannot build walls, seawalls, the whole shoreline, right? We need to be mindful of the costs associated with this adaptation. So can you elaborate more on the adaptation and localization of the adaptation?
Certainly, thank you for the question. So look, I might sort of set the context a bit as to the on the work that we've been doing at the NGFS's Adaptation Task Force. So the NGFS itself has been around for just over 7 years now, and you know, a lot of the work is focused on risk management, thinking about the implications of climate change for central banks, for the financial institutions we regulate. We've also given a lot of thought to the necessary response and the role that central banks and regulators have to play in fostering the flow of capital. Obviously, the response to meeting, you know, for example, meeting Paris goals requires a lot of mobilization of infrastructure, changes to sort of power generation, to transport, to agriculture, and so on. And that all requires capital. The financial institutions we regulate and supervise at the heart of the mobilization of capital. So we've got a role to play, at least in not getting in the way, but ultimately, ideally fostering those flows. But in thinking about that, much of the work up until very recently, the NGFS has really been focused on emissions reduction, so the mitigation side of risk management. But it's becoming increasingly clear to all of us, I think, that even if we take the optimistic view that we will still meet our Paris goals, we're already seeing the impacts of climate change today. There's a certain amount of climate change that's baked in. There will be impacts. So the need for adaptation is here, regardless of how successful we end up being on the mitigation side. So that's a real imperative. There's obviously limits to adaptation, you know, and so it has to be a both and. It has to be mitigation and adaptation. But we made the call earlier this year that we really wanted to mobilize some work on the topic of the adaptation side as well, and what that means for regulators like ourselves and how we can think about that. So we started the work in June this year. We've worked very quickly to put out a sort of first exploratory piece of work. We refer to it as a conceptual note that sort of maps out the landscape of adaptation, but importantly, bringing it back to, what are the implications and sort of further actions for central banks and regulators. And, we really do see adaptation as alongside mitigation as part of the risk management response to climate change. And one of the ways we articulated in the paper is we said, well, risks coming from climate change are kind of complex interaction of the physical, the actual climate hazard itself, our exposure, so that's human and the built environment, the exposure to that hazard, and then what is the vulnerability of that exposure. So you might be exposed but have a very resilient construction, or you might have a less resilient construction. And we basically characterize the task of adaptation as changes you make to that exposure or to that vulnerability, while mitigation is changes you're trying to make to the climate hazard itself. So that might be relocation of physical infrastructure. In Australia, there are some areas where, the difficult reality is that certain towns actually physically need to be relocated because the flood risk, for example, might be so intense. In other times, it might be reducing the vulnerability, increasing the resilience. So that can be community level. It might be things like seawalls, dams, levees, that sort of thing. It might be at a more local level, making houses more resilient to cyclone or to fire and so on. So all of that comes under the heading of adaptation. While it's not strictly kind of a form of physical adaptation, we also touch on the topic of insurance and the role that insurance can provide a signal to encourage adaptation, because obviously insurance premiums, as we talked about before, respond as a price signal of that risk, but they can also incentivize more effective adaptation. So we looked at sort of gap in financing, and if anything, the sort of financing gap for climate adaptation is even larger than the gap in mitigation. But there's a lot of important work that can be done. One interesting insight that we brought from some of the people we spoke to is that often when people talk about adaptation, they think about just those big projects like building the dams, the seawalls, and so on. But it's actually important just to sort of think about there can be a role of thinking about adaptation in essentially all infrastructure development. So if you're building a road, a hospital, any kind of built infrastructure, it can be built to the standards of today or the standards of yesterday, or it can be built to more resilient standards to be robust to the change of the future. And so a term that we often heard used was that where you're building infrastructure to the standards of 10, 20 years time, that can be thought of as adapted finance. So it's not necessarily the capital A adaptation, it's not those big community levels, but that's an important part in thinking about all infrastructure investment is making sure it's resilient to the future. But when we wrapped up that note, we sort of identified a number of areas for further work. And one of the key areas that we identified was this idea of international collaboration, because a lot of the thinking, the ideas, the way to approach it, there's a lot of value in that international collaboration, as Marc's already alluded to. But because it's so fundamentally tied to the physical risk, and as I said earlier, the physical risk is quite localized. Not everywhere experiences floods, not everywhere experiences fires, you need to work internationally, but then act locally. And that really is the challenge. And I might just give one sort of example of something that we've been part of here in Australia is that there's this grouping that was established called the Hazard Insurance Partnership that brings together a number of public sector agencies with insurers. And part of the role, there's a number of streams of work that group has in train. But one of the things that they're doing is that our Commonwealth government has provided commitments of funding for disaster readiness over a number of years, over a 5-year period. And they wanted the input from the insurance industry to ensure that at least some of that funding goes towards things that help bring insurance premiums down. Now, not all of it will. There are some things that are worthwhile investments for disaster readiness that won't impact insurance premiums. A good example is if there's a flood shelter and a refuge shelter built up in high ground near a town that's flood prone, that could save lives. It gives somewhere for people to escape to if the roads are blocked and so on. But if their houses are still underwater, it won't affect their insurance premiums. But there'll be other things that might actually go to hardening and improving the resilience of those houses that might do that. So I think thinking about quite specifically what are the investments that will make a difference, that's really part of that sort of acting locally response to adaptation.
Absolutely. No, it's I believe it's a very robust approach to it. You don't not necessarily expect the governments to act and adapt everywhere. We need to give a signal to the market and also to the homeowners and home buyers that they should not be building when there is a risk and areas of risk. So it's a fine balance between the government, financial institution, as well as private individuals, and where and how and to build. We have only a couple of minutes left. Marc and Ken, may I ask you if it's possible to pick up the question on the Q&A? So maybe, Marc, from your point of view, the first question, are regulators considering centralized funding to tackle climate risk? Would you, from the nature-based solution maybe, do you think of any, how do you take the question? How do you answer maybe? Are there any cross collaboration between regulators and international organizations in in securing some funding or for nature base or adaptation? Yeah,
it's a very good question. I would think it's also it's a complicated question. What I think, at least how also my institution looks at this, is that it is rather important that every institution, every organization, every actor in this stays close to what it's on Earth for. So to stick relatively close to its mandate, and we as a central bank do not consider ourselves the actor to finance a transition per se. We are there for sound risk management, for indicating, what could, to what extent financial institutions need to remain robust and resilient for the transition that's upcoming. And we tend to focus on that. We are rather not normative about where they allocate their funds to, as long as their risk profile remains robust and resilient. And we look at economic policymakers and elected officials to sort of guide us through the transition, and to set the parameters and to set the boundaries and to set the targets that we can then act on. That being said, I do think that central banks and supervisors have a lot of institutional knowledge that they can put into use to advise on this. So at least in my central bank, it is within also our mandate to provide our elected officials with the advice that they need to ensure economic development, financial stability, and what have you. And what we see is that they especially benefit from sort of data-driven, robust analyses that focus on the long term, because in the end, elected officials generally tend to have an horizon of only a couple of years, whereas this is a problem that obviously sits far ahead in the future, but that needs decisions to be taken today in order for them to be effective, in order for the transition to not be too much shocks. So I would see the main channel that we influence is through the advice that we provide, and that could also be advice on, how to finance this or how to mobilize the right funds. And then I think it's also up to, as I said, elected officials, but also very much, multilateral development banks and so on, to really decide to actually fund this and allocate the funds.
Thank you very much, Marc. There is a last question. I don't know, Kenneth, would you have any feeling, any answer to that? It's what role blockchain-based digital assets play in climate risk?
Thanks a lot. I think just very briefly, I don't follow that space closely, but I am aware actually of different solutions, I think, that harness the blockchain's ability, right, to provide in a way a decentralized and clear, trusted source of information to then tokenize, right, different types of relevant information or assets, which I've seen examples, ranging, from carbon credits to climate disclosures, which can then be verified by authorities. So what I would say is that think of them as building blocks, right? Some may not be smaller or not as verified as yet, but think of them as being part of an overall ecosystem that, depending on the use case that is being deliberated upon, may or may not be useful, all part of hopefully a potential solution. As Sean has said in the other chat, never say never. Let's try things out, see what it works. This could also be part of a potential solution as well. Thanks.
Thank you very much. Thank you very much. It's been 45 minutes, but it went past very quickly, very fast, at least from my point of view. I would like to thank you again for all the discussion, very insightful discussions for the audience. And beside that, I'll conclude with 3 points. The first one is, as you said, cross collaboration is key, is critical for designing a robust framework across jurisdictions. Open tools will make, and technology will make this collaboration easier and more efficient, more effective at the same time. But the last point, I think I'll come back to Sean, so I'll steal your sentence, that we have to work internationally, but implement and act locally. Because then that's how we can achieve effective, meaningful adaptation, whether it is relocation, resilience, or insurance coverage, etc. So it has to be on a local level. I believe with that, we're at the very end of the session. So thank you very much. Thank you to all the participants. Thank you for the questions, and I wish you a very good day, end of the day, or an afternoon, as well as a late morning. Thank you very much. Bye.
Thank you. Bye-bye.